Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, I would like to remind everyone not to buy that indexed universal life insurance policy. Over the last year or so, I have seen countless people post videos on social media talking about how IUL, or Indexed Universal Life Insurance, is the greatest thing since sliced bread. And typically, the sales pitch goes something like this. How would you like to enjoy all the upside of the stock market with none of the downside? Well, if that's you, I've got the product for you. In reality, these things come with all sorts of hidden fees and caps and limitations and are a terrible fit for almost everybody. In today's episodes, I talk about why this is the case, the ins and outs of indexed universal life insurance, and dig into the falsehoods that insurance representatives and people that I'm seeing out there on social media talk about. If ever you've considered one of these things, please listen to this episode before you buy one. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today on the podcast, I would like to talk a little bit about IUL, or Index Universal Life Insurance. The reason for this is there has been this phenomenon on social media over the last 12 to 18 months where insurance people are building a large social media following and espousing all the numerous quote-unquote benefits of indexed universal life. And I'm sure that there are people out there that are making a lot of money selling these products and collecting the commissions on them, because some of these social media personalities are getting millions of views on these videos, which seems totally crazy to me as someone who's been in the industry and knows a little bit about these actual products. So I wanted to talk about this product in specifically, and first and foremost, remind everybody not to buy these stinking things. These things are awful products for the most part. Well, I shouldn't say they're awful. They can work, I guess, but you are so much better off taking your extra cash and doing other stuff with it than you are dumping it into this indexed universal life policy. So that's the background of what I wanted to cover today. There's just been a lot of social media interest in the products, and if you're not sure if what you're watching is referring to an indexed universal life policy, I'll go over the details of them here in a moment. But if you ever hear the term, how would you like to enjoy the returns of the market in up years without ever losing ground in down years, without ever losing money when the market falls? How would you like to do that? Does that sound good? Well, if it does, then I've got the product for you. That's an indexed universal life policy. So let's back up a moment and just take a few minutes and explain exactly what these things are. An indexed universal life policy is a life insurance policy. It's a permanent life insurance policy. And longtime listeners will know I'm generally not a huge fan of these things. So a permanent life insurance policy is one where an insurance company takes, they're probably going to give you a paramedical exam where they evaluate your health, they take your blood, they take your urine, and then they assign you a health class. And then there's a policy that they're going to offer to you, where if you give them money, they're going to offer to pay your beneficiaries a death benefit if you die while the policy is in force. Very basic scenario. By and large, most people do not need permanent life insurance. They need term life insurance. Most people absolutely need life insurance at some point in their careers. If somebody else is in your household depending on your current and future income. Like for me, I'm married, I've got 3 kids at home. My wife stays home and watches them, gets them to and from school and all their activities and all that stuff. If I die prematurely, that's going to be a big problem for my wife and my 3 kids. So we have 3 different term life insurance policies that total a couple $1,000,000, so that if I die tomorrow, they will have that death benefit available to keep the lights on, not have to move. They'll be able to pay the mortgage and buy groceries without having to do anything totally drastic. That's an absolutely legitimate thing that millions of people around the country have a need for. A permanent insurance policy is that concept on steroids. So for your term policies, like the ones I just described, when I obtained them, I went through a paramedical exam. Somebody came by the office and took my blood pressure and blood and urine and so forth. And then they took that back to the lab. And then the lab that the insurance company hired for this evaluated it, and using all the data that they had about me, made some educated guess about how likely it was that I was going to die in the next 30 years. And based on the amount of insurance that I asked for, they quoted me a premium. So now I pay a little bit every month to this insurance company. And if I die again while the policy is in force, my wife collects the death benefit. Megan, if you're listening to this, please don't consider offing me because of all this. But the amount that I pay is directly related to my health class. So I give the insurance company a little bit of money. A small amount of that goes back to the representative who I bought the policy from. The rest of it goes to the insurance company for their margins and to pay a death benefit for the people in my class of policyholders that do wind up passing away. There's nothing more than that. It doesn't build up any cash value. A permanent insurance policy builds up cash value. So the amount that if you have one of those policies, the amount you pay to the insurance company includes the cost of the insurance, so the amount of your death benefit, inclusive of the likelihood that you're going to die. A portion goes in the form of a commission to the representative who sold the policy, and the amount of your premiums that goes toward commission to the representative in a permanent insurance policy is many times greater than in a term policy, because these permanent insurance policies are way more profitable to insurance companies. And the rest goes to the profit margin of the insurance company, but then a portion also collects cash value. So the simplest form of this is in a whole life insurance policy, which I've described before. Apologies if this is a repeat. But if you have a $500 premium each month and maybe $100 of it goes to the cash value, well, you have cash inside this policy, and it's going to grow a little bit every year based on the dividends that the insurance company pays you. It will probably earn a little bit more than what you might get in the bank on interest deposits in like a savings account. So these days, maybe you get 4% in a dividend in a whole life insurance policy. But the growth on that cash value is fixed based on those dividends. You're not taking market risk with it. You're not doing anything else. It's fixed. So that's the most basic form of a permanent insurance policy. A variable life insurance policy is the same concept. You get this insurance policy from the insurance company, life insurance from the insurance company. If you die, they pay the death benefit to your beneficiary. You pay a lot more each month, and some of that makes its way into the policy in the form of cash value. But with the variable policy, that cash value doesn't just sit there and earn dividends based on what the insurance company wants to give you. You choose investments to put the cash into inside the policy. They're called sub-accounts. Variable annuities they're the same way. So you might choose to invest in international or U.S. Stock markets, and most policies will give you a variety of these things to choose from. They're expensive. It's not a very effective way to grow wealth because of all the layers of fees and all the other stuff we're going to talk about today. But it's there. It's an option. And the benefit, the legitimate benefit here is that any growth in that cash value over time is all tax deferred. You don't pay tax on growth of the cash value, which is legitimately pretty convenient. So if you're someone who has a $500 premium payment and $100 of that is going toward the cash value, well, you might, in a variable policy, choose an S&P 500 fund. And in some years, the value of that fund will grow. In some years, it's going to fall. It's going to track basically the performance of the S&P 500. The indexed universal life policy that's making its way around the internet now is the next iteration of that. Rather than taking the cash value and putting it in an investment inside the policy, and these subaccounts, by the way, are very, very similar to mutual funds. So you're choosing an investment and its value is going to go up and down based on the performance of that investment. An indexed universal life policy is not going to be a direct investment in the markets. It's an agreement with the insurance company where they will say, we will increase your cash value if the markets go up, but we won't decrease it if they go down, which sounds pretty good. Sounds like you're getting all the upside with none of the downside. And what's actually happening is they have caps and crediting rates to where you don't get anywhere near the same return that you would get by investing that cash in the same index fund outside of the policy. So here are a couple examples of this. One that I've seen they will cap your returns at 10 or 12% per year. So if you put $500 a month into the policy, $100 of that goes toward the cash value. If you make 12, and I'm simplifying here a little bit, if you make 12 payments throughout the year, you're going to have $1,200 by the end of the year, plus whatever that growth is. So let's say that the markets are totally flat throughout the year until after you've made that last premium payment. And so all 12 of your payments have the exact same investment experience. Well, in the last month of the year, if you're tracking the S&P 500 and the market goes up by 20%, they're only going to increase your cash value by whatever the cap is. 10 or 12% are typically what I see here. So the other 8 or 10% on top of that, you're not getting at all. Another way that they will haircut this that I've seen is by a crediting rate. So again, same sales pitch. How would you like to enjoy all the upside of the market with none of the downside? Well, you put $100 a month into it. If the market goes up by 10% that year, they might only credit you 80 or 90% of the return. So if the market's up by 10, you're up by 9. Usually, what I see in these things is there's some combination of crediting rate and cap on your returns. If there's no crediting rate, then the cap's going to be a little bit lower. You might see a 15% return cap with like an 80 or 90% crediting rate. So they haircut the returns that they're giving you, number one. Number two, they're not incorporating any dividends whatsoever. So as you know, if you buy an S&P 500 index fund, you're buying a fund that's investing in each of the 500 underlying companies in the index. And a lot of those companies pay investors a dividend that you receive directly if you invest in the fund. Well, the insurance companies, through these indexed universal life policies, are not incorporating the dividends whatsoever, which is a larger component of long-term returns than I think most people realize. And so what always happens, this is every time I've evaluated one of these things for somebody, they come in with a policy illustration. And at this point, the person has met with the insurance salesperson, they've gotten some basic information, and they're quoting a premium, and that includes some long-term projections, or what they call policy illustrations. And they say, based on the last 10 years or this, 10-year period, at some point, if you'd put your money into this IUL, you'd be way better off than if you'd put it into the broader stock market. And what they're doing is omitting the dividends entirely, which is patently false, and it's completely apples to oranges, number one. On top of the fact that they're cherry picking the 10-year window that they look at in the policy illustration. So it's not an apples to apples thing. These guys will sell it as How would you like to get all the upside with none of the downside? Well, you're not getting anywhere near all the upside. The fact that they don't decrease your cash value, yes, that could be legitimate, but there are a number of other half-truths and flat-out inaccuracies that go along with the sales pitch. One of the legitimate benefits of permanent insurance that I mentioned is if you see growth in your cash value in one of these policies over time, it's totally tax deferred. You don't pay tax on that until the money comes out of the policy, which is a very nice benefit. When you pull money from the policy that's greater than the amount of premiums you put in, you're going to pay tax on that difference, which is unfortunate. Insurance reps, if you've gotten this far in the conversation, like to tout that these policies are akin to banking on yourself or having infinite banking opportunity. And they'll say that you can avoid paying taxes simply by taking a loan from the policy. And that is true, right? If you put $100,000 into one of these policies and, over the next decade, it grows to $200,000, you can pull money out through a loan from the policy without having to pay tax on that gain. But the loan's got to be paid back sometime. And you have to pay interest. And if you don't, and you run out of cash value in the policy, let's say you take all the cash value out of the policy through a loan so you don't have to pay tax on it. Well, guess what? It's still an insurance policy. You still have to keep the thing active. And in a permanent policy, you have to pay the cost of insurance every single year. So if it's a policy for $100,000 of death benefit, the likelihood that you're going to die increases every single year that you get older. And so the cost of the insurance is going to go up and up and up and up. This is not a level premium term insurance policy like I described here a few minutes ago. The premium and the cost of the insurance goes up every single year. So if you get to the point where you've pulled all the cash value out of this thing, and there's no cash value left to cover the cost of insurance, the policy is going to expire or lapse. And if the policy expires while you have an outstanding loan, you've got to pay tax on the entire amount all there immediately. So you can circumvent that issue with some sound planning. You just don't pull out all the cash value. Give yourself ample runway to where you don't risk having that huge, massive taxable event and tax bill down the road. But nonetheless, it's something that you have to manage against. And since this thing doesn't go away and the cost of insurance only goes up and up and up and up, it's a legitimate issue. Now, the loan still has to be paid. And so what insurance people will say is, well, you have you use this as an investment vehicle as opposed to insurance. You create it with the smallest death benefit that you can possibly create it with, which is, potentially that's a workaround. You're using it for a purpose it was not meant for, but that means that the cost of insurance is going to be lower if you have a smaller death benefit. That's a legitimate way to do it. But what the way it typically goes is that if you take money out of the policy, the idea is you don't want your beneficiaries to have to repay a loan on your behalf after you die. So that's what the death benefit is used for. Because remember, this is a permanent policy. It's not going to go away in your 70s or 80s. You take money out of the policy as you need to, tax-free, and then rather than having to repay the loan, you use the death benefit that you get after you die, that the insurance company pays your beneficiaries. That's what they use to satisfy the loan and collapse and close the policy. That is a potential way to do it. It's just so terribly expensive over the long term, it doesn't make any sense. And the thing that really grinds my gears about these things is that insurance reps actually get away with saying that there are no fees. The money that you put into the policy is not going to, we don't charge any fees against that. And on the surface, perhaps that's actually true, to where they don't take direct cash out of the cash value for, any kind of charge or expense. What they're doing implicitly is setting the caps on your returns and the crediting rates to where it's so profitable for them by limiting the returns that you get in the policy that they don't have to impose any of those restrictions. And what they're doing on the other side from a business perspective is hedging these things through futures contracts and swaps and other types of financial derivatives to manage their risk, which is a completely sound, legitimate thing to do. But it doesn't mean that the products are any better for you and me. There are huge costs and huge expenses to these things. They just might not be listed outright in a nice, neat way in the prospectus. It's the opportunity cost that you're going to forego over the lifetime of the policy. I've also seen these that do have outright costs. Every time you put money in, they might have like a contribution charge of 4 or 5 or 6%. If you put $100 in, then they're only going to credit you $95, $94, $95, $96 toward your cash value. They have distribution charges, they have surrender charges, and that's not to mention that the cost of the insurance each year is going to go up and up and up and up. So it's just one of these situations where I cringe if I run across one of these dopes on social media espousing it. They may have drunk the Kool-Aid themselves, but it's almost always by the posts are made by somebody on the younger end of the spectrum who is probably, trying to build a little bit of a revenue stream and a business for themselves. Nothing wrong with that, but they don't understand enough about personal finance to look outside the commission that they get from selling one of the policies. And they see social media as a way to just distribute a product that they might think is good, but is in reality just a really poor fit for most people. So again, there are legitimate uses of permanent life insurance, especially in a business setting. Buy-sell agreements might be funded with life insurance. What else? It's a way to mitigate estate taxes. You can use an irrevocable life insurance trust to where you create a trust, you put cash into it, the trust buys a life insurance a permanent policy on your behalf, and then the death benefit of that is used to pay estate taxes or meet other liquidity needs when you die. And here's another thing that, apologies for ranting so much today, but here's another thing that upsets me about these pitches is people will say, well, this is what rich people do. They use life insurance policies to their advantage to manage tax liability and estate taxes. Yeah, that's true, but we're talking about like 100 millionaires. I don't know any, and I know a fair amount of people who are worth, $10 to $20 million, maybe a little bit more than that. None of them use this stuff. It's all the people who are worth hundreds and hundreds of millions of dollars or billions. Because when you have that much wealth to your name, yes, there is an estate tax. But right now, the federal estate tax doesn't kick in until your net worth is more than $25 million for spouses. If you live in a state that imposes it, like Oregon has a tax that's imposed after $1 million for individuals, yeah, you can manage around it. But for the most part, that's not high on people's radar. They're not trying to minimize the estate tax. And for the vast majority of Americans with wealth less than $50 million, it makes absolutely no sense to pay all this money into one of these permanent policies for that purpose. If you have a big business, you have a partnership agreement that uses that requires that kind of funding, sure. But for tax deferral, estate tax minimization, by and large, most of us are never going to need that. Once your net worth climbs above 25, maybe 50 million bucks, yeah, potentially. But that's not most people. So I hope this was helpful and not too annoying for people. It is annoying for me when I see all these posts and people are getting a lot of momentum and likes because the basic pitch sounds great. How would you like all the return of the market with none of the downside? And very little of that is true. None of the downside, yeah, maybe, but they are really, like most permanent policies, like annuity policies, insurance companies are just taking their pound of flesh when they sell these things. You are so much better off having your assets available, flexible to you in an ordinary old brokerage account. Even if you have to pay tax on the gains, you're going to be so much better off long term. It just never makes sense to jump into one of these things. All right, that's it for today. Hope this was helpful, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.